Hello, fellow investors, and welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Jim Pfeifer. Jim is the founder, president, and CEO of Left Field Investors, which is now very recently transitioned into PassivePockets, which is an exciting transition that he'll be able to tell us about today. But Jim, thank you so much for joining the show.
Well, thanks for having me. It's great to be back.
Yeah, absolutely. Last time you were on with our friend Paul Shannon. You guys were talking about a little bit of a different tilt and strategy. So excited to have you on today to really talk about more about your community that you guys have built over the past, I know, several years now, and some pretty fantastic resource for passive investors. And so, as we dig in, we'll get into all those details. But before we do, let's start at the top, like we always do, and tell us a little bit about who you are, Jim, and how you got to where you are today.
Yeah, I'm kind of on career number 6, I think is kind of how I look at it. I was in college I was a finance major. I've always been really into finance, and for the first, I don't know, 25 years of my career, I was certain that the way to build wealth was through the stock market, mutual funds, and that was the only way to go. And so I had, several jobs. So I worked in for a reinsurance company, then I was a finance teacher, and then I became a financial advisor. And at the same time as I was a financial advisor, I became an accidental landlord. And so we had a rental that we rented out, and I handled that myself. And I really didn't like being a landlord, but I started to see what real estate can do and how powerful it was. And so as I was learning how to be a financial advisor, I was also learning more about real estate, and I realized, oh man, I want to be over here in the real estate and less in the paper asset world. And so I wasn't a financial advisor for very long. I did that for 6 or 7 years. And then I finally fully transitioned to real estate, where I started buying single family homes. Then I bought some small multis. And what I realized was I wasn't really very good as an asset manager. All of the properties increased in value, but that's just a function of the market. I had really good timing accidentally, but I didn't have the cash flow I expected. I didn't, I was constantly fighting with my property managers about tenants and all these things. And I just wasn't very good at managing those assets. And that's when I found real estate syndications. And that's where effectively now I hire an asset manager. It's their full-time job. It's all they do. And so I hire that person, and then they go out and find properties, buy properties, and I can choose on each deal they send me whether I invest in that deal or not. And the results have been the same or better than what I was getting when I was doing it on my own as an active investor. And it fits my personality more, right? I don't have to do the day-to-day work. There's a lot of active things in passive investing, and we can talk about that, but that's all before the deal. You don't have to manage the deal. And so when I got into syndication investing, I looked around and no one else that I knew was into it. So I looked for people who were doing it and started a small mastermind. That was the intent, and it grew into a large community, Left Field Investors. We turned it into a business. And the purpose of that business was to just help LP investors become better at this, because it's difficult. It's challenging. These investments are hidden. They're long-term. They're illiquid. You have to send wires. I mean, there's all kinds of things you have to do that you don't do in normal investing. And so a community really helps. And so we built up this community, and we got it to the point where we were doing great, but we didn't have the resources to really do all the things we wanted to do, to grow the community, to give the resources we wanted. So we partnered with Bigger Pockets, who, they have the world's largest real estate community, and they do mostly active. And so they were interested in starting a passive community, and we had one. So now we merged, and we started up PassivePockets, which actually launched just yesterday. We're in the middle of September here, and we're just super excited about the new community. It's very similar to the old community, but there's a lot of potential for growth and additional resources. So we're really excited about that.
Yeah, that's extremely exciting, and I love your story. I mean, I really kind of resonate with it, and this idea of, because I started as a passive investor first. That was really how I got into this. Little bit of a different tilt in that I actually realized I loved it and it was pretty good at it and wanted to go and become active in it.
Yeah.
And that set off, a whole chain of events, which leads me to where I am today. But I love the starting point and the tilt that you took on it, which was, recognize what fits your personality type, recognize what you're good at, and you realized that your path was to really focus on passive investing. Um, but you didn't just stop there. You said, well, yeah, even as a passive investor, as you alluded to, there's a lot of active components of this, and there's a lot that you probably don't know. And so you created a network around yourself to learn and grow and figure those things out. I think that's a tremendous value add for investors out there. So tell us more about what Passive Pockets really is and the value it brings and what you guys are really, I mean, what's your mission, what you've set out to do?
Yeah, I think, if you look at it, I think this is a team sport. If you walk out your front door and talk to your neighbors, your friends, and you say, hey, let's talk about personal finance, they're going to be talking about the stock market, their 401k, their IRAs, the interest rate on their mortgage. And then you're going to say, well, what about real estate and syndications? And then you'll notice everyone disappears, or who's this crazy guy talking about syndications, right? So it's complicated. And so the purpose of the community is to provide a group where you can find like-minded people to learn and grow together, because everyone is grown up learning and hearing about the stock market and your 401k. When you get your first job, your boss or your colleagues will say, hey, put some money in your 401k. Nobody questions it. But if you want to go outside the mainstream and get into alternatives, it's very complicated, because, as you know, some of these investments are hidden. They can't even advertise. So how are you going to find them? And then you have to figure out, how are you going to vet these operators, right? Because a lot of them have podcasts and do a great job, but they could be just great marketers, or they could be great operators, or they could be both. But how do you figure that out? And so what I've found is I rely on my community. We each, help each other. We talk. On PassivePockets, there's a forum, so you can interact with other investors and you can ask questions. Hey, is there anybody ever heard of ABC Syndicator? Oh yeah, I heard of them. Here's how, here's how they did for me, and here's what I think about them. And so I just can't overstate the power of community in this type of investing. And some of the other things, PassivePockets brings is educational resources. There's a whole course on the website that kind of, what's a syndication, all the way through how do I invest in it, how do I vet sponsors, all of that. And there's some very experienced people that presenting this information. Then there's articles and blogs and things like that. There's also you can connect with operators and sponsors. There's a deal page where they can post, operators and sponsors can post deals. Then the community can evaluate the deals and discuss them. We're trying to turn community into a verb, where we're going to community an operator, meaning we're going to vet them together. We're going to community a deal. We're going to vet them together. Now, that doesn't mean that we all make the same decisions. It just means that we're going to have a place where I can discuss, hey, this operator presented a deal this way, and here's what they're saying. And we can all talk about, I disagree with this. Oh, I love this. And it's just a community that is engaged. And the one thing that I think that left field investors and passive pockets both have is the culture. The culture of the community is just helping each other and trying to lift everyone. We're all working for the same thing, financial freedom, whatever that means to you. And so we're all working together to help each other get there. And that's what I love about the community most, I think.
No, I think that's awesome. I think it's a fantastic community, and like you said, it is difficult to find information. I mean, it can be difficult. Like when I started, my main source was podcasts. This was probably back in 2015, 16. There wasn't a lot out there. There's definitely more out there now, but still, like you said, you go to before Bigger Pockets had Passive Pockets, right? You're right. It was mostly active. There wasn't a lot of information on multifamily in general, but especially passive multifamily, right?
Right.
And so there weren't a lot of forums. And so I think it's just great because it is scary when you first start, and you don't know what you're doing, and it can seem like kind of a black hole when you start. So that's a fantastic value you guys are providing. I wanted to go back to something you said earlier, because you mentioned, when you go to you talk to your neighbor and you talk about like personal finance. I thought right there you were going to say crickets, not even going into
Well,
mortgage,
that's
stock
true
market,
too.
whatever.
Yeah.
Because I mean, that's one of the things that just surprises me is how little people really think about their personal finances and their future, and uh, what are they going to do in retirement, right? It just doesn't seem to be on a lot of people's radar. I mean, like when I bring that up to people, I get a lot of glazed over eyes. and
Yeah.
it's kind of, oh yeah, so we should probably think about that at some point. But I mean, what's your take on that? Do you find a similar thing, or how do you, yeah, what are your thoughts there?
As a former financial advisor, when people are finally ready to talk to someone about finance, all they want to talk about is retirement. And I think that's important. And I think the one thing that real estate kind of frees you to do is not just think about retirement, but think about now. Because I think, yes, you're right. Not many people want to talk about their finances with each other, right? But when they do, it's always going to be 401k and those kind of things. But what we're trying to do is say, look, you don't have to wait until retirement to use your money. You can use it along the way and grow it. And that's the difference between alternative investing and investing in, like the stock market, right? Because you get tax benefits along the way and you can grow your money in a different way. If you're just putting it all in a 401k to use later, there's a couple problems with that. One, that's the highest taxed money you'll ever have. You are saving taxes now at a low tax rate relatively, right? Because most people think tax rates are going to go up so that you can pay taxes later at a much higher rate. That doesn't make sense, right? But in real estate, you can pay no taxes if you do it right, legally pay no taxes or very little tax because of the tax breaks they give real estate investors. And you can use your money along the way because you're not locking it up in this in a vehicle that the government has control of. If you're doing a 401k or an IRA, you're a partner with the government. At any time they can change the rules, right? But if you have your money in real estate, it's your money to operate how you want. And if you change the rule, if the government changes the rules, you can change with it because you're not locked into a contract with the government already. So for me, it's all about real estate. And then how do you want to access it? Do you want to do what you do, which is active? You like it, you're good at it, go for it. Or what I want to do, which is passive, because that's what I like and that's what I'm good at. And so those are the kind of choices. And for me, it's not, I don't want to save all my money for the future. I want to save along the way and use my money along the way as well.
Yeah, Jim, how to change more people's mindset to think about, one, like the math just doesn't work on a 401k, right? You can't put 18,000 or whatever it is now away a year and then expect to live off the same salary if you're making, 100,000 plus a year now in your retirement. The math just doesn't work out, right? But how do you get people to change their mindset to understand that like 401k isn't the option and never was supposed to be for your only retirement plan? And two, how do you get people to think about like, man, it might be nice to touch that money before I'm 60. Like I might want to do something between the time I'm 45 and 60, um, and not have to wait. Like how do we change more people's mindset? What are you guys doing within Passive Pockets, or what have you done?
We're just trying to educate, right? And the best example I have is let's say that you decide you're going to do a 401k route and that's your retirement. So you're going to save and let's say at retirement you get $1 million, right? And you have $1 million in your retirement account. And every financial advisor is going to say, okay, you can take 4% out a year, right? Because because you have to live on that. Unfortunately, you don't know when you're going to die, so you don't know how much you can spend. So you can take 4% out a year. So you're going to take $40,000 out a year. And let's say it's 25% taxes for easy math. So you're going to have $30,000 net. That is the highest amount you will ever get out of that account because that account isn't necessarily going to grow because of the ups and downs of the market. So you're at $30,000 in your pocket every year. Okay, great. So then you look at me, I'm the real estate guy. I have $1 million at retirement and I'm going to invest that in real estate and pay almost no taxes. And the assets that I'm investing in are going to pay, let's say, 7% a year. That's typical cash flow, right? So I have $1 million. I'm collecting $70,000. If I do it right, I'm not paying any tax. So I'm 70,000 net compared to your 30,000 net, right? And that's the lowest I'm ever going to have as opposed to your highest because my assets are going to keep growing because the real estate is going to appreciate as well as spin off cash flow. So that's what we're trying to show people at Passive Pockets is you can do it. Here's a way. And it doesn't mean don't, take all your money out of the stock market and throw it all in real estate, right? You got to do it in stages and do something that makes you feel comfortable. But what we're trying to show people is that example, right? That is doable and it works and you can do it. It's just people don't know about it. So that's the whole point of Passive Pockets is is, well, 2 points really, is trying to go out there and say, hey, this is something you can do and join our community. And together we'll help you learn how to do it. And we'll all do it together to make everyone better at it.
Yeah, I mean, that's well said, Jim. I think everybody's got to pay attention to what Jim just said, and that math problem that he just put together very simply, because it's absolutely true. It's just like, man, I hate that people, you're making 80,000, 120,000 a year. And all of a sudden, I mean, many people are going to be in that situation. You're like, well, okay, I retire. I'm supposed to go out, have fun, travel, do all this. So, oh, wait, I can only live off 30,000 a year now. It's like, you really want to take a cut in lifestyle. I just think people aren't thinking about that fast enough. So I appreciate the analogy there, Jim, and laying that out for us. And I hope folks really take that to heart and start thinking about their future now, planning ahead for the next, 20 plus years. As we change topic a little bit and focus on, like you said, right now, we're time stamping it. We're kind of middle of September. You guys just launched Passive Pockets. Probably the second biggest thing that hit the news that I care about after that is that we just had a half percentage point rate cut from the Fed that we've all been waiting on for about 2 years now. And so in this environment where, the economy's slowing down, inflation's slowing down, rate cuts are starting to happen, we expect more to come. What's the guidance in the network in Passive Pockets on, what does that mean to investors? How does that impact investors? What should they know and what should they be paying attention to right now?
I think this is a great question. And unfortunately, there isn't a great answer yet. I mean, I'm excited that rates have dropped, but at the same time, nothing really has changed yet, right? Because a lot of times these are already baked in. People were expecting this. So mortgage rates aren't going to drop instantly. All the good stuff isn't going to all happen instantly. What's interesting is over the next year, they're talking about, interest rates will drop by 1.5% or more, and that will make some changes. But I think the smart play is to not overreact. Right now, in the last year or so, our community has been very interested in debt offerings. So they've been investing in debt because interest rates were higher and it's less risky. And so I think the change that we're going to see is there's going to be maybe fewer debt offerings, and you're going to see more equity offerings come out, and people are going to be more interested in equity offerings. And operators, I mean, you can talk to this, operators are going to be able to um, get better terms on the debt than they had before. And so that's going to help move some of these deals that have been stuck. I think a lot, especially in multifamily, there's operators who are just trying to survive. They say survive till 25. There's all kinds of different things that people are saying, but trying to survive to the interest rate cuts. Well, now we're here. That's not going to save all your old deals. It might help some of them. It might save some of them. But I think what I'm trying to encourage people, this is not automatically, now we're back in 2019 and 20 when the real estate market was going crazy. We're not going to jump back there. What we need to do is take the lessons that we've learned, which are increasing costs and interest rates going up. They cause other problems. So let's look forward and try and see, okay, what are now they're coming back down. As you said, inflation is coming down, interest rates are coming down, but there's other things that we need to make sure of. Unemployment, right? That's expected to keep rising. So that affects multifamily for certain. So I think people are super excited about this, and I think they should be. Rates going down is going to be a good thing for real estate, but I would just caution people not to get overexcited and think we're jumping right back into 2019 where, everything just goes up.
Hmm. Well, I think that's a good cautionary message. I think you're right. There's a certain amount of things are priced in to a certain extent. As we're looking at deals, that's definitely a component of it. And you can see some are a little more aggressive at pricing in up front than others. I think on the operator side, what's been interesting over the past couple of years is people just trying to figure out what is the market for deals, right? And I mean, it's not uncommon for for offers when we're offering on properties to come in, and there's a 20% spread between the top offer and the bottom offer. because nobody really knows how to price things because, and a lot of it is because of interest rates, right? So I think as we start seeing things come down, I think that spread decreases. I think we see more transaction volume. I think for passive investors, what the good news I believe will happen is a lot of the deals that people expected to, like, people were used to signing up for a 5-year hold, but it really only lasted 24 months, right? And there was several years of that, and everybody was just benefiting because cap rates were compressing, and value was being created. So sponsors were just selling out of things. I think a lot of people right now have their liquidity stuck in deals that were supposed to sell in 22 and 23 and 24. And so I think what we will see is we'll start to see in 25 and definitely 26 and 27 some unwinding of that and start to see some liquidity back into people's pockets, which I'm sure passive investors will all appreciate, and the opportunity to kind of redeploy and chalk up some of those gains that they expected to come. And so I think that'll be a positive for everybody as we start to see transaction volume increase.
Yeah, I totally agree because, one of the mistakes I think some people make, and I definitely made this when I looked into or started getting into real estate syndications and passive investing, was I was so excited about it and was just so confident that this was the way that I kind of went all in. And one thing that I didn't recognize enough was the liquidity issue, because deals were going 2 years, 3 years instead of 5 years full cycle. And so I was constantly getting new liquidity. Well, when the market changed, everything locked up. And so I had very little liquidity and I hadn't planned for that appropriately. And so, that's one of the biggest lessons I learned from this is, it's a snowball that grows. So once you get into it, keep making investments regularly, but don't go all in. And also remember that one of the big differences between the stock market or even active real estate is once you invest in these deals, you don't have a choice of when you get out, right? Even in an emergency, it's very hard to get out of these deals. In real, if you own a single family home that you rent out, you could sell it at any time. Yeah, you might not get top of the market money if you're selling, under duress, but at least you can sell and get some of your capital back. These syndications you can't. So you really have to monitor your liquidity.
Yeah, I really, really good point. I think that's a great tip. And it's one thing to build net worth, but you also have to pay attention to cash flow, right?
Absolutely.
And paying those day-to-day bills. And so I think that's great guidance. What another question I was going to ask you, and you answered it a little bit. You said there was like a trend toward debt in your group and the type of investments that were popular over the past couple of years. But any more insights on within your network and all the great um, just minds around passive investing? I mean, what type of deals are people looking at? Are there certain asset classes? Are there, certain niches or things that folks have found successful, or they've kind of been in vogue and popular within your network?
Yeah, it's really been debt has been super popular over the last year or so, but we're slowly seeing um some more equity deals pop up, multifamily, self-storage, industrial. A lot of it is in funds now. I think that was a slow shift post-pandemic. A lot of companies switched to funds rather than single asset deals. And I think it seems like that might be part of a cycle, right? At the top of the cycle, people, operators want big chunks of money. They can go out and buy a whole bunch of deals. So I would not be surprised if some of these equity deals, we start seeing some of the companies that were doing funds go back to individual deals, because it's still the transaction volume, as you said, I think is going to pick up, but it's still going to be slow out of the gates. And so it might be hard to put together a fund for multifamily when you don't know how many assets you're going to be able to acquire. So I would expect that we might see fewer funds and more individual syndication deals, which has its pluses and minuses for investors. But at least I think the big plus is right now investors are still cautious, and we want to underwrite every deal and make sure that we're looking at every single deal rather than just investing in a fund through an operator. So I think we have seen a lot of debt offerings, but I think I think we'll still have the debt, but we're also going to get a lot more access to equity deals, and that's really where you get the upside, right? And so we'll be back to having some upside. And I also, as you said it right, we're going to have more liquidity because other deals are going to start going full cycle. And hopefully we could also have some of the operators that have stopped distributions, maybe if they have adjustable rates and maybe those adjust down and maybe rate caps aren't quite as expensive, that maybe they start cash flowing some of these deals again. So I think I guess I'm back to the interest rate conversation, but what I really think is like there's a big dam, and that, they're letting a little bit of water over the dam with each rate cut that they're going to do. And this first one is going to help a little bit, but it's really, as you said, 25, 26, where we're going to see the positive effects of this.
Yeah, it's really, I think, going to be this kind of two-headed dragon, if you will, this impact of this liquidity freeing up. And I agree, there's been a lot of groups, whether you've had to stop a distribution, right, because of variable rates, that's going to start freeing up. You're going to have liquidity free up. And then, I think also we're going to hit this unique, we've hit this already, this kind of supply cliff, right? Where the other impact on interest rates going up was, one of the most difficult loans to get is a construction loan, right? And they usually have the highest interest rates, highest spreads, and it's one of the things that banks tighten up on. And so what we saw was construction loans deals just not penciling out and loans not getting done. And so we've seen now supply over the next 2 years extremely minuscule. I mean, kind of to the impact of what happened post pandemic, where for 2 years we had no building, and then all of a sudden we had interest rates, and everybody's surprised rents growing at 8, 10, 12% a year, right? I mean, I think it's potential that we kind of see this again as we see, um, supply hitting a cliff, and we see this huge wave of demand. And we see this growth, and we see kind of this return to, I don't think to the extent maybe we saw, but to a similar environment where you have a great time for investing because you have demand guiding us through growth. We have inflation down, so expenses aren't rising at the clip they were. And people have liquidity at what I think will be a very opportune time to be reinvesting, because you're always thinking about what's that reinvestment risk, right? Can I reinvest in something that's going to give me the return of what I was in? And I think it's going to come together over the next couple of years, to be pretty fortuitous for folks. I mean, it's my hope, and I'm sure I'm biased because I'm an operator, but I see these things coming together, and I think this could be just great timing.
I completely agree, because it's telegraphed, right? I mean, there's a bunch of multifamily apartments that were delivered this year, and some even next year, but it takes 2 or 3 years to develop those. Well, right now there's almost zero multifamily in development, as you mentioned. So what does that mean for 2 years from now? It means there's going to be very few deliverables. So that's, the supply is not going to be increasing, and you're going to have more demand. So what's going to happen? That's going to drive rents up. So the next few years for multifamily could be, really, really good years. And again, hopefully it won't be the boom years that we had before, because we know what follows a boom is what we're going through now, right? Which is the difficult times. So if we can just have measured growth, I think that would be best for everybody.
Yeah, prudent, measured growth. That's what we're wishing for.
Yeah, good
We're
luck.
gonna we're gonna put that intention out there.
Exactly.
Jim, one more question I wanted to ask you. We have a lot of listeners who haven't invested yet. They're listening because they're thinking about investing in real estate, right? They're thinking about maybe investing in a syndication or in some type of deal. For those folks, I'm sure there's some fantastic lessons you've pulled out of your community over the years, or you've experienced, personally. What are some tips for those folks that are trying to dip a toe in? Maybe they're not sure yet. How can you help them gain the clarity to know they should take action? Because as you said, you don't want to be the guy that's sitting there with 30,000 a year in retirement. You want to be the guy that's sitting there with 70K and appreciating assets.
Yeah, well, I think you just said it right there. You want appreciating assets, right? And if you look at it, the stock market, that's paper assets. And if Apple can have the best year they've ever had, but if the stock market goes down, Apple's going down. But if you buy a multifamily property in Phoenix, Arizona, and the real estate market in Dallas goes down, that's not necessarily going to affect your deal in Phoenix. So you got to look at, if you want to get into real estate, this is the same whether it's active or passive. It's super scary at first. And the biggest thing I can say is you just got to try it out. You got to take that step and do all your due diligence. I think joining a community is one of the most important things you can do. But at some point, you're going to have to take action. And that action is going to be actually calling up some operators, talking to them, trying to get the measure of them. Don't invest with the first one you talk to. Call 3 or 4. Have a 30-minute conversation with them, because you want to not only like the operator as a business person or want to invest in their business, but also the person themselves. You're going to be in business with this person for 3, 5, 7, 10 years, right? It's got to be somebody that you're comfortable with. And another difference between the stock market is I can't call up Tim Cook and say, hey, I'd like to talk to you about how Apple's performing, right? But if I invest with you, an operator, I can call you up and say, hey, how's my deal going? And you're going to respond if I picked the right operator. So I think it's one of those things where you just have to make sure you have the education, but don't wait until you have all the education, because I've been doing this for a long time and I don't have all the education. I made a ton of mistakes, and that's how I learned. I learned through my mistakes. The nice thing about a community is I can learn from other people's mistakes as well. But it's really, you have to take action. You just have to do that first deal and then be patient, right? One of the things that a lot of people do is they do that first deal, they get those first distributions, and they're like, wow, this is great. And then they do 6 more deals with that same operator. We have one of our community members. He has a great rule. He does not invest with an operator a second time until at least 1 year has passed. And that's just to make sure that everything's going the way that it should go. So I think you got to take action. You can't just keep trying and learning and fidgeting about. If you want to do it, you got to jump in and do it.
Well said, Jim. I appreciate the insights. I know some folks are going to get some great value out of that. As we move to the end of the show, we're going to take you through my keys to success round. I got 4 questions I want to ask you. The first one is, if you could only ask a sponsor one question before you send that check, what is that one question you would ask?
Well, so communication is always the most important thing to me, but I'm going to change the answer a little bit. Is right now, I would ask, how did you communicate the difficulties to your investors during the current, during the downturn that we just had? How did you talk to your investors and say, hey, whether your deals were struggling or not, there's potential for most deals to have some issues, right? How did you communicate that? How did you get through the downturn? But how did you communicate that to your investors? Were you somebody that unfortunately had a capital call and you prepared your investors 6 months before? Or did you have a capital call and you prepared them 6 minutes before you sent the email saying, hey, it's a capital call? Huge difference to me. So my number one question would be, what was your communication like during these the difficult, uncertain times we've had recently?
I think that's really good. And I love how you brought that timeliness into it of just what we've experienced. And, I think that it's naive to think there's never going to be any problems. I mean, real estate, you really make money in real estate by solving problems. I mean, that's what good operators do. It's not that there's not going to be a problem in the deal. It's just, what is it? And have they experienced it before? And how do they manage through it? And so I think that's really important. I love that answer. What is the one thing in your career you're most proud of?
Most proud is that we started Left Field Investors, the community we built, and the culture of that community that the members of the community built, and then how we were able to transition that into PassivePockets. I'm super proud of that, because I really feel like a community like PassivePockets is going to be able to help so many people get into real estate that otherwise could not, because they didn't want to be active, or there were, they didn't have the skills to be active. But this is accessible to anyone. And so, yeah, I think I'm most proud that we have this community and we found a way to sustain it and keep it growing by merging with PassivePockets.
I love that. What is a book that everybody should read?
So my number one book for passive investing, well, there's a couple, but the one I'll talk about is by Steve Sue, who was one of the founders of Left Field Investors. They changed the title now for PassivePockets, but it's called Avoiding Rookie Passive Investing Mistakes. And the only thing I don't like about the title is it's not for rookies. It's for rookies and for experienced people. And the whole point of it, there's 20 mistakes that Steve or people in our community have made. And this just shows you how to avoid those mistakes. And that is really, in your education, you want to learn all you can about syndication investing, but you don't want to go through and make all the mistakes that I made, that Steve made, that some of the more experienced people made. You want to look at our mistakes and not do any of those, avoid them all. And, I think the two things that'll make you build wealth the fastest is one, mitigating your taxes, because that's the biggest eroder of wealth. And two, avoiding mistakes, because that's another way to lose money. And so it's a quick read. You can read it in an hour. It's not a thick book, but man, it's powerful. It packs a punch.
Yeah, it sounds impactful. We'll definitely make sure we link that below so folks can easily access it. And last question for you, Jim. What is your number one key to success?
Well, I'm going to sound like a broken record, but it's true. It's the community, right? Building a network, whether you build a network that turns into a community or you join a community, this type of investing especially, you have to have a network, a community, other people that you can learn from, because these are long-term, illiquid investments that you have no control over. So the only way to really properly vet an operator is to know someone who's already invested with them. And there's a lot of other information you get from the community. So I am a big advocate of this is a team sport. You need a community to be successful. And what I always say is, look, if you want a community that the culture of the community fits your personality. So if you go on to PassivePockets and it doesn't fit you, go find another community. There's other communities out there. I'm completely biased. I think PassivePockets is the best community, but if it's not a fit for you, find something else. But if you want to be a successful investor in real estate syndications, you need a group, you need a community, you need a network.
Absolutely. Well, Jim, thank you so much for joining today. Thank you for just bringing so much value. Thank you for the work you're doing outside of this and building that community and helping people get into real estate and make good investing decisions. I mean, that's ultimately what this show is about. I love the mission of what you guys are doing. You're creating tremendous value out there. Before I let you go, if folks want to learn more about PassivePockets, what you guys are doing, how can they reach out?
Yeah, go to PassivePockets.com. As we said, we just launched the website. You can do a 7-day free trial and kind of test it out, give it a run and see if it's for you.
Very cool. Jim Pfeifer, everybody, with PassivePockets.com. Go check it out. And with that, Jim, hope you have a great rest of the day.
Thank you.
Thanks for listening to another great episode of Ritter on Real Estate. Hit the subscribe button to make sure you don't miss out on the content that will make you a better investor. Also, visit KentRitter.com for articles, videos, and tools curated just for passive investors. Until next time, this is Kent Ritter with Ritter on Real Estate. Now go out and invest like a pro.